What does the 10-year bond tell us? Actually, very little. The reality of sovereign bonds these days in developed markets is that what they're basically reflecting is that central banks will implement more quantitative easing and more liquidity injections and keep very low rates no matter what. When the yield of the sovereign bond goes below 1.2% in US Treasuries, obviously, that means that people might have a certain level of growth scare, and certainly that the improvement of the economy is not as robust and optimistic as consensus had estimated. However, very, very, very unlikely that the 10-year bond is discounting entering into a phase of deflation, let alone that the steepening of the yield curve is showing recession. Why? Because both the yield and the curve are being artificially depressed and artificially managed by the central bank. When the central bank purchases 100% of net issuances, we cannot say that yields or the curve are showing anything but what the central bank is going to do in about those net purchases. So basically what we are seeing today in bond markets is simply the reflection of what is an artificial managing of the curve and an artificial management of yields. What we must understand as well is that central banks are incentivizing too much risk, and therefore these type of growth scares generate ripple effects into other asset classes because the level of risk that investors take is too high. Therefore, no, a bond yield at 1.2% in the US Treasury doesn't mean that we're entering into a deflation situation. It means that the central bank is going to continue to be 100% of net issuances no matter what. But more importantly, that the risk of stagflation is not small because the elevated levels of prices generated in the first part of the year remain sticky, even when the trend of growth moderates slightly. So don't pay so much attention to the yield and the yield curve, because both of them are artificially disguised by central bank action.